David Tepper has always challenged the crowd, and one of his most powerful truths is the idea that cash is not trash. In a world obsessed with being fully invested at all times, this mindset feels almost rebellious. But for retirees, it is not just smart, it is essential. Cash represents freedom. It is the quiet strength in your portfolio that doesn't make headlines but makes survival possible. When markets are calm, cash may look boring. When markets turn violent, cash becomes priceless. It allows retirees to step back, breathe, and think clearly while others are driven by fear. For someone living on a fixed or semi-fixed income, cash creates emotional stability. It removes the pressure to sell long-term investments at the worst possible moment just to cover living expenses. When you know you have cash available, market drops don't feel like personal emergencies. Instead of panic, there is patience. Instead of anxiety, there is confidence. Cash gives you the ability to wait, and waiting is often the most profitable decision an investor can make. Tepper understands that markets move in cycles, not straight lines. There will always be downturns, corrections, and unexpected shocks. Retirees who are fully invested are often forced into defensive decisions at exactly the wrong time. But those holding cash or money market funds can turn chaos into opportunity. When prices fall and fear dominates headlines, cash allows you to buy quality assets at discounted prices. While others are selling out of necessity, you are positioning out of strength. Cash also provides flexibility that no other asset can match. Life doesn't follow a perfect financial plan. Medical needs, family responsibilities, or sudden opportunities can arise without warning. Cash ensures that these moments don't derail your long-term strategy. You are not locked in. You are not trapped by timing. You have options, and options are power. Many people misunderstand cash as doing nothing. Tepper sees it differently. Cash is an active decision. It is a strategic position taken with intention and discipline. Holding cash means you respect risk. It means you understand that protecting capital is just as important as growing it. Especially in retirement, the goal is not to win every year. It is to survive every year. There is also a psychological advantage that cannot be overstated. Cash helps retirees sleep at night. It reduces stress, second-guessing, and emotional decision-making. When you are calm, you think better. When you think better, you invest better. Tepper's philosophy reminds us that peace of mind is a return in itself. In the end, cash is not about fear of the market. It is about confidence in yourself. It allows you to move deliberately instead of reactively. It turns downturns into preparation phases instead of panic moments. For retirees, cash is not wasted potential. It is stored strength, waiting patiently for the right moment to be used. David Tepper has always believed that real strength in investing comes from businesses that can produce cash consistently, regardless of headlines, politics, or market noise. For retirees, this belief is especially powerful. Strong dividend-paying companies are not about chasing excitement or speculation. They are about reliability, discipline, and endurance. These are businesses that wake up every day and generate money quarter after quarter, year after year. That consistency becomes a source of stability for retirees who depend on their investments to support their lifestyle. Dividend-paying companies with durable business models tend to operate in industries people rely on no matter what is happening in the economy. Whether markets are booming or struggling, these companies sell essential products or services, maintain customer loyalty, and protect their margins. Tepper respects this kind of resilience because it reduces uncertainty. When a company has survived recessions, inflation, rate hikes, and market crashes, it proves that its business model is built for the long haul, not just good times. Pricing power is another critical factor. Companies that can raise prices without losing customers protect their cash flow during inflationary periods. For retirees, this matters deeply. Inflation quietly erodes purchasing power, and dividends from companies with pricing power can help offset that loss. Tepper understands that income isn't just about yield, it's about sustainability. A dividend that can grow or at least remain stable through difficult environments is far more valuable than a high yield that disappears at the first sign of trouble. Strong dividend companies also reduce emotional stress. Retirees don't have to rely solely on selling shares to generate income, which means they are less exposed to bad timing. Even when stock prices fluctuate, dividends can continue to arrive. That steady income stream creates confidence and predictability, allowing retirees to stay invested through volatility instead of reacting emotionally to short-term market moves. Tepper's approach avoids reckless risk by focusing on quality over hype. He values balance sheets that are strong, debt levels that are manageable, and management teams that understand capital discipline. Companies that prioritize shareholder returns through dividends often demonstrate financial maturity and responsibility. They don't gamble with the future of the business. Instead, they focus on steady growth, operational efficiency, and long-term survival. Another overlooked benefit is compounding. When dividends are reinvested during stronger years, they quietly build additional shares, increasing future income potential. Over time, this disciplined approach can significantly strengthen a retirement portfolio without the need for aggressive strategies. It aligns perfectly with Tepper's belief in patience and positioning rather than constant action. Ultimately, strong dividend-paying companies represent confidence, not complacency. They allow retirees to participate in the market while minimizing unnecessary risk. Tepper's respect for these businesses comes from understanding that wealth preservation is just as important as wealth creation. In retirement, steady income, durability, and peace of mind matter more than dramatic gains. Dividend-paying companies deliver exactly that, a foundation built not on hope, but on proven performance and consistent cash flow. David Tepper has never confused excitement with intelligence when it comes to investing, and his view on bonds reflects that discipline clearly. Bonds are not designed to make headlines or spark emotional highs. They are designed to protect capital, stabilize portfolios, and provide reliability when uncertainty takes over. For retirees especially, this distinction is critical. At a stage of life where preservation matters more than aggressive growth, bonds serve a quiet but powerful role, one that often becomes most valuable when other assets are under pressure. Tepper emphasizes the importance of understanding interest rate cycles because bonds do not exist in isolation. Their performance is deeply connected to monetary policy, inflation, and economic momentum. Retirees who blindly hold bonds without understanding these cycles may feel confused when prices fluctuate. But when bonds are held with intention and awareness, they become strategic tools rather than passive holdings. Tepper's approach encourages investors to respect the environment and adjust exposure thoughtfully instead of reacting emotionally. Quality is at the center of this philosophy. Government bonds and high-grade corporate bonds are not about chasing yield, they are about trust. These instruments are backed by strong institutions with the ability and willingness to meet their obligations. In times of market stress, investors naturally seek safety, and money often flows into high-quality bonds. This movement can help offset losses in riskier parts of a portfolio, providing balance when it is needed most. For retirees, this balancing effect can be life-changing. Market volatility doesn't just impact account values, it impacts emotions, decision-making, and confidence. When equities fall sharply, a portfolio anchored by quality bonds tends to decline far less, or in some cases even rise. That stability can prevent panic selling, which is one of the greatest threats to long-term financial security. Tepper understands that avoiding catastrophic mistakes is often more important than maximizing returns. Bonds also provide predictability. Unlike stocks where future returns are uncertain, bonds offer known income streams and defined maturity dates. This predictability is incredibly valuable in retirement planning. It allows retirees to match income needs with bond maturities, reducing the risk of being forced to sell assets at unfavorable times. Tepper values this structure because it turns uncertainty into planning and planning into confidence. High-grade corporate bonds add another layer of opportunity without excessive risk. These are companies with strong balance sheets, consistent earnings, and responsible management. They offer higher yields than government bonds while still maintaining a strong margin of safety. Tepper's focus on quality ensures that retirees are compensated for risk without stepping into speculative territory that could threaten capital. Understanding duration and interest rate sensitivity is another part of Tepper's disciplined mindset. When rates rise longer, duration bonds can suffer price declines. Tepper encourages awareness rather than avoidance. By diversifying across maturities and focusing on quality, retirees can reduce sensitivity to rate changes while still benefiting from the protective nature of bonds. This thoughtful construction transforms bonds from static holdings into dynamic risk management tools. Perhaps the most important role bonds play is psychological. They act as shock absorbers, not just financially, but emotionally. When markets turn volatile and fear dominates headlines, bonds provide reassurance. They remind retirees that not every part of the portfolio is exposed to the same risks. That reassurance helps investors stay disciplined, avoid emotional reactions, and maintain long-term strategies during short-term chaos. In Tepper's philosophy, bonds are not a weakness or a concession to age. They are a sign of wisdom. They represent respect for uncertainty and recognition of risk. For retirees, bonds offer something more valuable than excitement. They offer stability, predictability, and protection. In a world that constantly changes, that kind of reliability becomes a powerful foundation, allowing investors to move through market cycles with confidence rather than fear. David Tepper's long-term success can be traced back to a simple but powerful principle: don't blow up. This rule may sound basic, but it is the foundation of everything that separates great investors from reckless ones. Tepper understands that no amount of brilliance matters if a single bad decision wipes you out. For retirees, this lesson is even more critical. At this stage of life, there is limited time to recover from major losses. Protecting principal is not a conservative weakness. It is a strategic necessity. Many investors fall into the trap of chasing high returns, believing that bigger gains will solve all problems. Tepper rejects this mindset. He knows that survival comes first. For retirees, the goal is not to double money quickly or beat every market benchmark. The goal is to maintain financial independence for decades, not just years. A large loss early in retirement can permanently damage a portfolio, forcing lifestyle cuts, emotional stress, and irreversible decisions. That is why Tepper prioritizes risk control above all else. Consistency is the quiet hero of long-term success. Retirees do not need dramatic wins. They need steady progress and stability. A portfolio that compounds modestly but reliably will outperform a volatile one that swings between big gains and painful losses. Tepper's philosophy teaches that avoiding large drawdowns allows compounding to do its work uninterrupted. When capital is preserved, time becomes an ally instead of an enemy. Discipline plays a central role in this approach. Tepper does not allow emotions to dictate decisions. Fear and greed are responsible for most investment failures, especially during periods of extreme volatility. Retirees who lack discipline often sell at market bottoms or chase rallies too late. By contrast, a disciplined strategy focused on preservation reduces emotional pressure. When you are not trying to hit home runs, you don't feel forced to act. You stay patient, measured, and rational. Smart allocation is the practical expression of this philosophy. Tepper understands that no single asset should dominate a portfolio. Diversification is not about owning everything. It is about balancing risk intelligently. For retirees, this means spreading exposure across cash, bonds, dividend-paying stocks, and selective growth opportunities. Each component has a role. Together, they create resilience. When one area struggles, another provides support, reducing overall volatility and protecting capital. Another key aspect of don't blow up is knowing when to step back. Tepper is not afraid to reduce risk when conditions become unfavorable. This flexibility is a strength, not a weakness. Retirees benefit greatly from this mindset. They do not need to be fully invested at all times. Holding defensive positions during uncertain periods can prevent large losses and preserve both capital and confidence. This philosophy also changes how success is measured. Instead of focusing on short-term performance, Tepper evaluates outcomes over full cycles. For retirees, this long-term view is essential. A year of underperformance means little if the portfolio remains intact and capable of supporting future needs. Avoiding catastrophic mistakes allows retirees to stay in the game long enough to benefit from recoveries and opportunities. Perhaps most importantly, protecting principal protects peace of mind. Financial stress can erode quality of life faster than any market downturn. Tepper's rule encourages retirees to prioritize stability over excitement, clarity over complexity, and endurance over ego. When you know your foundation is secure, you make better decisions in every area of life. In the end, you don't need brilliance to succeed in retirement investing. You need restraint. Tepper's rule of don't blow up is not about fear. It is about respect for risk. By focusing on consistency, discipline, and smart allocation, retirees can build portfolios that are strong enough to weather their storms and steady enough to support a lifetime of security. David Tepper's approach to investing is rooted in patience, a quality that often gets overlooked in a world obsessed with speed and constant action. He does not believe that success comes from predicting every market move or reacting to every headline. Instead, he waits. This ability to remain calm, observant, and disciplined allows him to act only when the odds are clearly in his favor. For retirees, adopting the same mindset can be transformative because patience reduces mistakes and protects both capital and confidence. Many investors feel pressure to always be doing something. Markets move, news breaks, and emotions rise, creating the illusion that inaction is failure. Tepper rejects this idea. He understands that most market noise is just that, noise. Retirees who learn to ignore short-term fluctuations avoid unnecessary trades that often lead to losses. When you are patient, you stop reacting emotionally and start thinking strategically. Emotional decisions are the greatest enemy of long-term success, especially in retirement. Fear during market declines can push investors to sell at the worst possible time, locking in losses that might have recovered with time. Greed during rallies can tempt investors to chase inflated prices, increasing risk just as conditions become less favorable. Tepper's patience acts as a filter, preventing these emotional extremes from influencing decisions. Retirees benefit immensely from this discipline, as it helps preserve stability during volatile periods. Waiting does not mean being passive or uninformed. Tepper is constantly studying the environment, assessing risks, and identifying potential opportunities. He simply refuses to act until conditions align. This approach allows retirees to remain prepared without being pressured. Instead of forcing trades, they can maintain a watchful stance, knowing that opportunities will appear naturally over time. Patience also aligns perfectly with the realities of retirement investing. At this stage, the objective is not to outperform everyone else in the short term, but to sustain wealth over the long term. By letting opportunities come to you, rather than chasing them, you reduce turnover, costs, and stress. You allow high-quality investments to work over time, instead of interrupting compounding with constant adjustments. Another benefit of patience is clarity. When you slow down, you see situations more accurately. Tepper's waiting strategy allows him to distinguish between real opportunity and temporary excitement. Retirees who adopt this mindset become more selective. They invest with purpose, not impulse. This selectivity improves outcomes by focusing capital where it truly belongs. Patience also reinforces confidence. When you trust your strategy and give it time to work, you are less shaken by short-term setbacks. Tepper's success demonstrates that waiting is not weakness. It is strength. It allows you to act decisively when the moment is right, rather than hesitantly in response to fear or greed. In the end, patience turns investing into a process rather than a reaction. For retirees, this means fewer regrets, fewer mistakes, and greater peace of mind. By waiting instead of predicting, you allow discipline to replace emotion and strategy to replace stress. Tepper's mindset teaches that sometimes the most powerful move in investing is knowing when to do nothing and being comfortable with that choice. Liquidity is one of the most underappreciated strengths in investing, yet David Tepper understands its true power, especially for retirees. Liquidity means having access to your money when you need it, without being forced to accept large losses or long delays. In retirement, life does not always follow a predictable path. Medical expenses can arise suddenly, family members may need support, or unexpected opportunities may appear. Liquidity provides the flexibility to respond to these moments calmly and confidently, instead of under pressure. Tepper values investments that can be adjusted quickly because he understands that conditions change. Markets shift, personal circumstances evolve, and economic environments rarely stay stable for long. Retirees who hold illiquid assets often find themselves trapped, unable to act when action is required. Selling at the wrong time or under unfavorable terms can permanently damage a portfolio. Liquidity prevents this by keeping options open and risk controlled. One of the greatest advantages of liquidity is emotional stability. When retirees know they can access funds without disruption, they are less likely to panic during market downturns. Fear often comes from feeling stuck. Tepper's approach reduces that fear by ensuring flexibility is built into the portfolio. With liquid investments, retirees can cover expenses or rebalance portfolios without selling long-term holdings at distressed prices. Liquidity also enhances opportunity. During market sell-offs, prices often fall faster than fundamentals change. Investors with liquid capital can step in and acquire quality assets at discounted valuations. Tepper has built much of his success by being ready when others are forced to exit. For retirees, liquidity allows participation in these moments without jeopardizing financial security. It transforms volatility from a threat into a potential advantage. Another important aspect is timing control. Liquidity allows retirees to choose when and how to adjust their investments. Instead of reacting immediately to market noise, they can plan changes thoughtfully. This control reduces transaction costs, tax consequences, and emotional mistakes. Tepper's philosophy emphasizes preparation over reaction, and liquidity is central to that discipline. Liquidity also supports balanced living in retirement. Financial independence is not just about net worth, it is about freedom of choice. When funds are easily accessible, Retirees can make life decisions based on values and needs rather than financial constraints. Whether it is healthcare, travel, or helping family, liquidity ensures that money serves life, not the other way around. Importantly, valuing liquidity does not mean avoiding long-term investments entirely. Tepper understands balance. Retirees can hold growth assets while maintaining sufficient liquid reserves to handle the unexpected. This combination allows portfolios to grow while remaining resilient. It protects against forced selling, which is often the most damaging action an investor can take. In essence, liquidity is about control. It gives retirees the ability to adapt without stress, to act without panic, and to seize opportunities without regret. Tepper's respect for liquidity reflects his broader philosophy of risk management and flexibility. By prioritizing investments that can be adjusted quickly and efficiently, retirees build portfolios that support not only financial security, but also peace of mind and freedom throughout retirement. David Tepper has always emphasized that clarity is a competitive advantage in investing. In a financial world filled with complex products, layered strategies, and confusing promises, simplicity often delivers the strongest results. Tepper understands that complexity can disguise risk, making it harder to see where real dangers lie. For retirees, this lesson is especially important. When investments are difficult to understand, they are difficult to manage, and what you cannot clearly see can quietly work against you. Complex investments often come with hidden fees, leverage, or structures that behave unpredictably during market stress. They may look attractive during calm periods, but when volatility rises, these strategies can unravel quickly. Tepper avoids this trap by favoring transparency. Retirees who follow this approach reduce the chance of unpleasant surprises. When you know exactly how an investment works, you are better prepared for both good times and bad. Focusing on what you understand creates confidence. Retirees should not feel pressure to own every new financial product or follow every trend. Tepper's mindset encourages investors to stay within their circle of competence. This does not limit opportunity, it protects it. Simple, well-understood assets allow retirees to make decisions based on logic rather than fear. When markets fluctuate, clarity helps investors stay disciplined instead of reacting emotionally. Transparent investments also make it easier to align portfolios with long-term goals. Retirement investing is not about complexity, it is about purpose. Each asset should serve a clear role, whether it is income, stability, growth, or liquidity. Tepper believes that when every part of a portfolio has a defined function, the entire structure becomes stronger. Retirees benefit from knowing why they own what they own and how it supports their future needs. Another advantage of simplicity is easier monitoring. Retirees should be able to assess their portfolios without needing constant professional intervention or advanced financial knowledge. Simple investments allow for clear evaluation of performance and risk. This visibility empowers retirees to make timely adjustments when necessary. Rather than feeling overwhelmed or dependent on others to explain what is happening, clarity also reduces stress. Financial anxiety often comes from confusion. When retirees do not fully understand their investments, every market move feels threatening. Tepper's approach minimizes this anxiety by eliminating unnecessary complexity. When you understand your portfolio, you trust it more. That trust leads to better decision making and a healthier relationship with money. Simplicity does not mean being unsophisticated. Tepper's success proves that straightforward strategies applied with discipline can outperform complicated ones over time. Retirees who focus on clear, transparent assets avoid overtrading, excessive risk, and hidden costs. They allow compounding to work naturally without interference from unnecessary complexity. In the end, clarity wins because it keeps investors grounded. For retirees, this grounding is invaluable. Simple, transparent investments aligned with long-term goals create stability, confidence, and peace of mind. Tepper's philosophy reminds us that you do not need to outsmart the market. You need to understand yourself, respect risk, and keep your strategy clear enough to follow through. No matter what the market does,